Does the 4% rule still work? The short answer is yes, but it's not just the set and forget it rule that it used to be. The 4% rule basically says that in retirement, you should be able to draw out about 4% of your savings each year, and you adjust that for inflation and you won't run out of money. But the question is this, does it still work? Well, not as a rule, but as a guideline, as a starting point for planning, it's a good place to start thinking. A lot of things right now say that you should lower it a little bit, and this is what we're going to get into. Some things say lower, some things say higher. Nobody's perfectly right. You got to build something specific for your family. But a lot of research right now, as of June of 2026, says that you probably need to lower it between 3 and 3.5% of your portfolio. But the biggest shift is this. Flexibility matters more than exact percentages. Know what makes sense for you and your family and build out plans for that. Number one, what does the research say right now? Well, the new safe range is a little lower than 4%. Again, if you have $1 million in your 401k, the rule of 4% would say take $40,000 out a year and just use that, and the money should last you 30 years. So that's what the rule said. Well, now Morningstar and a lot of other firms are coming out saying maybe it's 3.9% or 3.7% or 3.3%. Depending on who you're reading, they keep lowering the number of what is safe. Why? Well, there's quite a bit. Forward-looking projections of the stock market say that once we get past this bull run we're on, we probably aren't set up for crazy returns for the next decade to 20 years. So as a result, they're saying if you expect lower returns in the market, you probably need a little bit of a lower withdrawal strategy. Again, 4% isn't wrong. You just have less margin for error than you did back in 1995 when it came out. Even the creator of the 4% rule, he's changed his thoughts on it. Bill Bengen, he invented the rule back in 1995. He's an economist, and he said that the 4% rule would work. Think about 1995. Where were CD rates? Where were 10 and 20 and 30-year treasuries? Where were bond rates? What was the stock market doing? Stock market was going up double digits every year. CDs were still paying out 6% per year. A lot of good things in the market that said just trust it and run with it. Then came 2000 through 2009. It's called the lost decade. The market was lost. There's a negative decade in the stock market. But after the bull run, Ron, he says he thinks you can take out more than 4%. He said you can look closer to 4.5%, 4.7%. So while Morningstar and other places are saying take out less, this guy's saying take out more. How do you know what the right number is? There is no perfect number. It's about what makes sense for you. So you need to figure out your own setup and build from there. Another thing, why does the rule feel less reliable today than what it used to be? Well, there's been some big structural changes in the stock market and in our economy. Number one, again, I mentioned this, but lower expected returns in the future. The stock market is not projected to do as well as it has been doing. We're on a historically good run in the market, especially since really the bottom of 2009. And with AI and the tech swell, things are going crazy, really, really good. Can it sustain forever? Probably not. So when these pullbacks happen, how do you manage that? Number two, higher and unpredictable inflation. We've seen that 2022, 2023, huge spike in inflation. It started coming back down, but even now in June of 26, we're starting to see it creep back up again. So if my lifestyle creeps up, does my withdrawal strategy have to creep up, or do I have to live on less? That's a decision to make. Also, don't forget this. People are retiring for longer. If you retire at 55 and you live to 85, that's a 30-year retirement. My grandfather's 95. So what if you live to 95 years old? That's a 40-year retirement. So now the money has to last longer than just 30 years. At the end of the day, the original rule was built for a different economic world. 1995 is a whole lot different than where we are today. I was on AOL still in 1995.
You've got mail.
We're not doing that anymore. So be aware that life is just different and money's different. Understand too that under certain conditions, the rule of 4% can still work. If you retire at 65, live a 30-year retired life, you have a balanced portfolio, a standard retirement 60-40 portfolio, you should be okay. They say 95% of the time it works. However, I'd like to see that number close to 100. If you got on a plane and they said this plane is 95% likely to land the right way, you'd probably get off because it's just not a comfortable risk number we want. Financially, I'd say let's be a little bit wiser than 95%. When does the rule of 4% break down? Well, let's start with this. You're at a higher risk of breakdown if you retire young. If you want to get out at 50, at 55, and you retire and you got to live off this money for 40 years, that's an issue with the rule of 4%. Another thing, if you refuse to adjust your spending in a downturn, now that sounds like you're being stubborn or selfish, but if you build your lifestyle around a certain amount, let's say you build your lifestyle on a $50,000 withdrawal, but now the market drops. That happened for retirees in 2000, 2001, 2002, 3 straight years of negativity in the stock market. The market dropped for 3 years and people had to decide, do I take the same income or do I take the same percentage? Because the market dropped, do I take less money so I can stay with my percentage or do I take the same income? So you have to make those decisions. But if your life requires $50,000 a year and the market drops your portfolio, now I'm taking out $50,000 of a smaller asset. That's an issue you have to deal with. The other thing is if you're heavily invested in one asset class, if you're all tech and tech corrects like it did in 2022 and Netflix dropped 60%, Disney dropped 80%, if you're heavily invested in one sector, that's a real issue. And the other one is if you hit a stock market crash early in retirement. I had a client who retired in 1998, had a great plan all set up, and then the first 5 years of retirement, 3 of them were negative in the stock market. That's called sequence of returns risk. When you're pulling money out of your account, if the market goes up to start your retirement, you win. If the market goes down to start your retirement, you lose. So that's what's called sequence of return risk. You can't control it, but know that it affects your ability to withdraw from your portfolio. At the end of the day, flexibility beats precision. That's the modern strategy. It's 2026. If you're using 1995 rules or 1965 rules, it just doesn't work the same anymore. Flexibility will always beat precision with the way things are going now. We have these V-shaped market corrections. We have quick stock portfolio adjustments where the market drops for 2 weeks and recovers it all back in 3 weeks. Well, if you abandon ship at the bottom and then it runs up and you miss the recovery in the first 7 to 14 days, there's all these reasons to say, gosh, I shouldn't have been so dogmatic about it. What you need to be dogmatic about is being flexible. I understand that market's going to go up and down. I understand inflation's going to go up and hopefully it comes back down. I understand that gas prices are going up and hopefully they come back down. How do I adjust? How do I pivot and not just do some pick a number and stick with it strategy, but instead I'm willing to adjust my withdrawals based on market performance. When things are good, pull a little, live a little, put some more money in your bank account as a cash reserve, as a safety net. What do I do if there's bad years? Maybe I should pull back or pull from my cash reserves. Another thing is, should I really be using the market to cover all of my lifestyle, my goals? Or should I be building a plan that says, if things go bad, I've got some provisions. I've got some safety net that says I can pull from an annuity. I can pull from my cash reserves. I pull from safe money. That way I'm not subject to bad times in the market changing my life. It's good to have cash buffers. It's good to have an annuity you can turn on for income later on. It can safely support higher starting withdrawal strategies. If you retire young and healthy, you want to travel. You want to do things, but you don't want to overspend the first 5-10 years and put yourself in a hole for the rest of your life. End of the day, the 4% rule isn't dead. It just grew up. Today, it should look more like a guideline and a starting point rather than the destination. If you use 4% as a starting point, if you want more safety, consider a little bit lower withdrawal strategy. If you retire young and you've got a long run ahead of you, you may want to consider that. Or think about this. If I'm willing to front load retirement, I want more up front, but yet knowing that down the line at age 80, I won't spend as much money, you may want to use an annuity to hit some guaranteed income. That way I never have to worry about running out at the end. Have flexible spending plans that adjust. Have an income strategy that's customized to you and your goals. Listen, if we can help in any way, just go to our website, michigansretirementcoach.com. Click on the link below. We'll have a conversation, answer your questions, and help you understand how the rule of 4% can be built for your life.